$2,000 a month in rent on a 3-bedroom house you own free and clear, no mortgage, no management company, a tenant who pays on time, that leaves you about $880 a month of actual spendable cash. Not $1,600, not $1,400, $880. And I'm going to build that number line by line in front of you so nobody can tell me the rent was fake. You've probably met the 50% rule. Half your gross rent vanishes into costs, half survives. That rule is real and it's useful, and it was never designed to answer this question. It's a screening shortcut for operating expenses before financing, and it doesn't contain a single dollar of income tax. Once you add the part where the government treats your rent as ordinary income, the real bite on a paid-off door lands closer to 56 cents of every dollar. The famous number wasn't wrong about roofs and insurance. It was wrong about being the end of the sentence. So there are two questions on the table. Where does the 2,000 actually stop falling? And then the one the title promises, there is a rent level where this door beats the same money sitting in an index fund, and I'm going to solve for it. It isn't 2,000. Before the arithmetic, the market. Because the assumption everyone fights about is the rent. The Census Bureau's housing vacancy release on July 28, 2026, put the national rental vacancy rate at 7.3%, the highest since 2017. For single-family rentals specifically, 6.1%. And median asking rent on a 3-bedroom single-family house in the first half of this year came in at $2,100, down 1.6% year over year across 1,099 cities. So $2,000 a month is not a fantasy rent. It's slightly below the national median. The turn already happened, quietly, while people were still repeating that rents only go up. Here's the property, a 3-bedroom worth $300,000. Paid off no mortgage, no lender, no amortization schedule. Average property tax state? You manage it yourself, so the management line is 0. You're a single filer in the 24% federal bracket, which in 2026 starts above $105,700 of taxable income. And your modified adjusted gross income is over $200,000, which matters later. This is deliberately the most flattering, honest version of a one-door rental. No debt, no manager, no bad tenant. Start with the calendar. $24,000 a year of scheduled rent assumes the house is occupied every month for 12 months, which no house is. At the single-family vacancy rate of 6.1%, you lose about $1,460 a year to empty weeks and turnover. That's not a disaster year. That's the average year. Spread out 3 weeks of nobody paying, a cleaning, a listing, a showing schedule, rent collected, $22,550. Now, the first cost, and it's the one that changes the whole logic of the thing. Property tax is charged against the value of the house, not against the rent it produces. At 1.1%, this house costs you about $3,300 a year. Left over, $19,250. And if you own in one of the counties in Texas or Illinois where effective rates run 2.5% to 3.2%, that same line becomes $7,500 to $9,600, a quarter to a third of your gross rent gone to a single bill on a house that produces exactly the same rent as the one in the cheap county. Same building, same tenant, completely different investment. Landlord insurance is the second bill written against the house rather than the rent. National average around $1,500 a year, with a realistic range of $800 to $3,000 for a 3-bedroom rental. And the top of that range clustered where hurricanes, hail, and wildfire live. Take the average, leftover, $17,750. And notice what you now own. 2 of your largest cost lines are indexed to the value of the building. Your revenue line is indexed to what a tenant will agree to pay this year, which just fell 1.6% nationally. Those two numbers move independently. A soft rental market does not send you a smaller tax bill. Remember that, because it comes back with teeth in about 8 minutes. Then where? Maintenance and repairs on a single-family rental run 8 to 15% of gross rent as a planning assumption. Call it 10% $2,400 a year. That's not a catastrophe fund. That's the water heater element, the garbage disposal, the fence panel, the plumber's trip charge, the lock rekey between tenants. Leftover, $15,350. Repairs are not replacement though. And this is the line one-door owners genuinely do not book. Capital reserves the money that exists because the roof has a lifespan. 1 to 2% of property value per year is the standard reserve assumption. So $3,000 on this house, which means your reserve line is twice your maintenance line and double your insurance premium. Look at it from the other end, if that feels heavy. A roof replacement divided by the years it lasts, plus an HVAC system divided by the years it lasts, plus a water heater, plus flooring between tenants. That's the $3,000. Skipping it doesn't make it disappear. It moves it onto a future Tuesday when the number arrives all at once. Leftover, $12,350. Add those four cost lines, and you're at 42.5% of gross rent inside the 35 to 45% operating expense range single-family rentals get underwritten against and sitting in the upper half of it. Add the vacancy haircut, and you're at 48%. So the 50% rule from the outside was almost exactly right about the operating side. It just stopped one line too early. And I'm keeping management at 0, which is generous, because hiring it costs 8 to 12% of collected rent, $1,900 to $2,900 a year on this door. I'll price your hours honestly later, but understand the trade you've made. The lazy version of this asset is not the free version. There is no arrangement where the house has no manager. So the ledger reads $12,350 a year, about $1,030 a month. Half your rent survived. Most people would call that the answer and go shopping for a second door. By the way, if you like housing numbers built in the open like this, clicking subscribe genuinely helps. So thanks to everyone who does. Because that $1,030 is pre-tax. And that's not a footnote. It's the hinge of the entire comparison. Rent lands on Schedule E as ordinary income, taxed at your marginal rate, not at capital gains rates, not at qualified dividend rates. The deductible expenses are the property tax, the insurance, the maintenance. The reserve is not deductible because setting money aside isn't spending it. So your taxable rental income is $15,350. 24% federal plus the net investment income surtax that lands on passive rental income at the income level we set at the top. The rate and the threshold are on screen. Call the bill $4,265. Cash actually in your account, $8,070 a year, $670 a month. The $2,000 rental is now paying you a third of its headline, which is the point where your accountant walks in, and to be fair, walks in with something real. Depreciation, you write off the building, not the land, over 27.5 years, straight line. Call the building 80% of the purchase price. So $240,000 divided by 27.5, and you get about $8,700 a year of deduction. That costs you nothing in cash. Your taxable rental income drops from $15,350 to about $6,650. Your tax falls to about $1,845, and your cash rises to $10,500 a year, $880 a month. There's the number from the first 10 seconds, arrived at from the top, with every line visible, except about 200 of that 880 is borrowed. Depreciation isn't forgiveness, it's timing. When you sell, every dollar you depreciated comes back as unrecaptured, Section 1250 gain, taxed at up to 25% federal. And the rule is allowed or allowable, meaning if you never claim the deduction, the recapture bill still exists. Hold this house 15 years and you've deducted about $130,000 of building, which arrives at closing as a tax event you did not budget for. The $200 a month is a loan from the Treasury at a rate you don't get to negotiate. Now, 2 objections are already typed in your head, so let's close both. The first is passive losses. Yes, there's a $25,000 allowance that lets you deduct rental losses against ordinary income, and it phases out 50 cents on the dollar once your modified adjusted gross income passes 100,000. And it's gone entirely at 150,000. For this viewer, it's already gone. The second is the 20% qualified business income deduction. That requires the rental to be a trade or business. And the safe harbor the IRS laid out in Revenue Procedure 2019-38 asks for 250 hours of rental services logged per year. separate books and records, contemporaneous time logs, and it excludes triple net leases. An owner who wants one quiet door and no paperwork does not clear that bar. The two most cited tax rescues for a small landlord are both closed for the lazy version of this asset. Look at the incentives around the transaction rather than at anybody's intentions. Nobody is lying to you. The reason the gross number travels is that everyone in the chain around the transaction is paid on price. And on doors, the agent, the lender, the pro forma spreadsheet with rent at the top and a mortgage payment at the bottom. Income tax lives on your return, not on their model, and reserves live in a year they'll never see. The advice that a rental replaces a paycheck isn't a conspiracy. It's a sentence that was written when rents were climbing and it never got updated. In 2026, asking rents on single-family homes are down, vacancy is at a 9-year high, and rent concessions are running at their highest share since 2014. The inflation hedge you were promised is currently offering your tenant a free month. So now put the same money on the other side of the page. $300,000 in a broad index fund at a 3 basis point expense ratio. Annual cost, $90. That's the entire operating statement. Large American stocks have returned roughly 10.1% nominal per year, with dividends reinvested over the long run since 1926, about 7% after inflation. That average is built out of a century of violent up years and down years, and it arrives in swings rather than in equal installments. Take 4% a year out of that account, and you have $12,000, $1,000 a month, and only the embedded gain in the shares you sell is taxable at long-term capital gains rates rather than your ordinary bracket. Meanwhile, the principal you didn't sell keeps compounding. $12,000 against $10,500, $1,000 a month against $880. On cash alone, the fund wins by a modest margin, and it wins it with 0 tenants, 0 vacancy, 0 deductible, and 1 cost line. Which finally lets me answer the question the title asks. What rent does this exact house need for the door to catch up? Hold everything else fixed. Same $300,000 value, same tax rate, same insurance, same reserve, same 6.1% vacancy, same depreciation. And solve for the rent that leaves $12,000 of after-tax cash. It's about $26,500 a year, $2,200 a month, which is a gross yield of 8.8% on the value of the house. The national median asking rent for a 3-bedroom single-family home in the first half of 2026 was $2,100, $100 a month under the line this house has to clear, and falling. So the median American rental door at the median American rent is below its own break-even before anybody has paid you for a single hour of your time. That's not a bad deal you can shop your way out of by negotiating harder. That's the structure of the asset at current prices. And yes, the 4% withdrawal is a conservative benchmark against a long-run 10% return. I'm using it on purpose because it's the number this audience already trusts. Raise the assumed return, and the bar for the house gets higher, not lower, which leaves leverage as the last rescue, and leverage in 2026 makes it worse. Freddie Mac put the 30-year fixed average at 6.66% for the week of July 30th, 2026, the 4th consecutive weekly increase and the highest in a year. That's an owner-occupant conforming average, so treat it as a floor. Investment property paper typically prices a quarter to a half point above it. Put 25% down on this same house and finance $225,000 at 7.2%. And principal and interest run about $1,520 a month, $18,250 a year against $12,350 of pre-tax operating cash. You're negative by roughly $490 a month, every month, funded out of your paycheck. Leverage doesn't create return. It multiplies the gap between your net yield and your borrowing rate. This house's net yield before tax is 4.1%. The rate is 7. Multiplying that gap gets you a bigger version of the wrong sign. Borrowed money works beautifully on real estate when the yield sits above the rate. Right now, on most single-family doors, it doesn't. If you've made it this far, you already know the channel. Clicking subscribe helps more than you'd think, and I appreciate everyone who does. Here's the part that's uncomfortable rather than mathematical. The instinct that got you to a paid-off house and a real portfolio was operating. Doing the work yourself, watching the details, being the person who handles it, that instinct is now the expensive one. Self-managing this door is roughly 100 hours a year of your late career time to protect about $2,400 of management fee you'd otherwise pay from an $880 a month cash flow. Your job changed from operator to allocator, somewhere around the point where the portfolio got big enough to matter, and the cost of not noticing is that you keep buying yourself work at $24 an hour pre-tax. Exit day makes the same point in one line. Leaving the house costs 6 to 8% in commissions and closing friction, plus recapture on every year you depreciated. Leaving the fund costs a click and capital gains tax on the gain only. And appreciation doesn't ride in to fix the yield. Long-run American home prices have run in the mid 4% range nominally, about 1 to 2% after inflation. That's a fine tailwind. It's not a rescue. Now the honest counterweight, because the door does win in real conditions. When researchers looked at 16 advanced economies from 1870 to 2015, housing and equities produced broadly comparable long-run real returns, near 7%, with housing showing lower volatility. That's genuine evidence. It's also aggregate national housing, with rental income included, thousands of properties smoothed together, not one address, with one tenant, one county assessor, and one roof. Your roof doesn't get cheaper because roofs elsewhere held. And within that, the individual door genuinely wins on high rent-to-value markets, low property tax states, holding periods measured in decades rather than years, self-management you actually want to do, forced savings if a liquid account tends to become spending money, and shelter living in it, which is a real benefit and never an investment return. So here's the 10-second test on your own property. Take annual rent, divide by today's market value. Paid off, self-managed, average tax state, you need roughly 8.5% to 9% for the door to beat the same money in an index fund on spendable cash. In a county running 2.5% to 3.2% of value instead of 1.1%, that tax line takes another $4,200 to $6,300 a year out of this house, so add 1.5 to 2 points. Hiring a manager at 8 to 12% of collected rent, add about one more. Below that band, you're not running an investment. You're running a job with a building attached, and it should pay you like one. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks.